Pierre-Olivier, thank you so much for being with us. The message that we have received from the IMF is that inflation is contained globally. However, how worried are you about a potential return of inflationary pressures, especially due to the geopolitical risks?
Well, so first we should acknowledge that it's very good news that overall global inflation is continuing to come down. It's expected to reach central bank inflation targets in 2025 for most countries. What we're seeing is, when we're looking at inflation risk, we're seeing two things. First, we have to be careful about some components of inflation. So for instance, we know that service prices inflation has been relatively elevated and remains elevated in many countries. It's about twice as high as it was before pandemic. So why is inflation coming down? Well, it's not because of services. It's mostly because goods price inflation has been lower than, in some cases, what we had before the pandemic. And so going forward, it's important to continue to watch what's happening with services. Then we have to be careful about potential new shocks that would then restart the inflation process. Some of it could be coming from geopolitical tensions, increase in commodity prices, maybe increase in food prices in some countries, increase in shipping costs. And it could also be as a result of policies taken by some countries. For instance, if we have overly stimulative policies in some economies, then that could create strong demand, and in turn that could lead to inflationary pressures.
We are days away from the US election, so what does the scenario of a Trump win mean for global inflation?
Well, so I want to be careful. We're not assessing different platforms or making any pronouncement about elections in any country. What we are seeing as part of the risk assessment we do for the global economy is to try to think about scenarios that might have some probability and that could impact the global economy. So one of those scenarios would be, for instance, if we have an increase in geopolitical tensions, that could lead to an increase in the price of oil, or that could lead to an increase in shipping costs. That would be bad for the global economy. Less activity, more inflation. Another layer of a downside scenario would be, what if we have increased tariffs or trade-distorting measures that are taken by countries, industrial policies or trade policy measures, and that are taken by countries against other economies in the world. We've seen some of that. We've seen certainly a ramp up of trade-distorting measures in the last few years. There are 3,000 or more of them now. It was about 1,000 in 2019. There was even less before that.
We know some of the measures that Trump might implement. We know that he's planning to raise tariffs. He's planning to lower taxes. And this might translate into higher deficits and higher debt. And you have already warned about the high debt of the United States and the global economy. So what does this scenario mean to the public debt of the United States?
I don't have a way to assess what it would do in one case versus the other. What I can say is that at the current juncture, where the US economy is operating slightly above its potential, so it's an economy that is running strongly, but slightly above its potential, and that's the reason the Federal Reserve is keeping rates, even though they've cut them by 50 basis points, they're still elevated. Now keeping rates tight is because it's trying to cool off this economy, bring down the economy to potential output. In that context, having more fiscal stimulus, wherever it comes from, would be something that would add additional pressure to the economy and would potentially lead to additional inflation, and then would require that the Federal Reserve has to do more to try to fight that inflation.
You have mentioned the Federal Reserve, so do you think that the 50% cut, which was a large cut that we have seen from the Federal Reserve, do you think that it was justified?
Well, we believe that the Federal Reserve made the assessment, which is correct in our view, that as inflation is showing signs that it's coming close to target, and not just in September or October, but also in the continuation path, if you want, and that this service price inflation I was mentioning earlier is also expected to ease, then at that point the central bank has to start having a little bit of a broader focus on their lens, not just looking at price inflation and bringing that down to target. That job is almost done, but making sure that going forward it doesn't maintain a monetary policy that would be too tight, because then that would start hurting activity in the country. And then when it's a country the size of the US, you would have also spillovers to the rest of the world.
And how many more cuts do you expect for this year and next year?
We are expecting an additional 2 cuts for 2024 and an additional 4 cuts for 2025.
Let's discuss China now. You have lowered the growth expectations for the Chinese economy. Do these expectations take into consideration the latest measures, stimulus measures that we have seen from China?
To some extent, but not fully. Let me explain. There were 2 rounds of announcements that were made. At the end of September, the Chinese Central Bank, the People's Bank of China, announced a number of monetary and financial measures. These are incorporated in our forecast. They are going in the right direction. Then there was a subsequent set of announcements made a few weeks ago by the Ministry of Finance, more fiscal measures, also going in the right direction, but we don't have all the details. So we haven't assessed the impact of these last batch of measures on the Chinese economy. Where does that leave us? Well, some of these measures, if they are implemented and are going in the right direction, they could provide some additional support to the Chinese economy. But this is in the context in which the latest numbers that have come out, some of them even after we locked in our projections, for instance, the growth numbers for the 3rd quarter of the year, have been a bit disappointing. So we're in this tension between, on the one hand, a Chinese economy that seems to be slowing down maybe a little bit more than was anticipated, and then potentially having some policy measures that will offset that.